What if I told you that one of the best investing playbooks for today wasn't written last week or last month, but over 30 years ago? Well, today we're going to dive into Warren Buffett's 1991 letter to shareholders and pull out 10 timeless lessons that are just as powerful now as they were back then. So why this letter? Why 1991 specifically? Well, this number is a pretty good reason. In 1991, Berkshire Hathaway's net worth grew by a staggering 39.6%. You know, a year like that has some serious wisdom baked into it, and we're about to unpack the thinking that made it happen. Okay, so what's the first thing Buffett does after announcing that massive gain? This is what's so incredible. He immediately tells everyone, hey, don't get used to this. He explains that as the company gets bigger and bigger, finding deals that can actually move the needle gets exponentially harder. This right here sets the stage perfectly for our first big lesson. So before we get into the specific tactics, the real nuts and bolts, we have to understand the fundamental mindset. This first section is all about Buffett's big picture philosophy. It's the high-level view that really informs every single decision he makes. And here's that first lesson, right off the bat. Understanding the challenge of scale. What works when you're investing $1,000 just doesn't work when you're investing billions. I mean, as Buffett put it, back when Berkshire had $20 million, a $1 million idea was a home run. But by 1991, with a $7.4 billion company, they needed to find a $370 million idea just to get that same impact. It's a huge reminder that your strategy has to evolve as your capital grows. Oh, this is a classic, a true Buffettism. He tells investors to focus on what he calls look-through earnings. Basically, that's your personal slice of the profits from the actual businesses you own stock in. The idea is to watch the companies themselves, the playing field, not the scoreboard, which is just the stock price bouncing around every single day. Okay, next up, the investing playbook. This is where we translate that big picture philosophy into direct, actionable principles. These are the core rules of the game. I mean, what a line, right? This perfectly captures his stay put, or what you might call his Rip Van Winkle approach. We live in a world that's just obsessed with constant trading, but Buffett argues that the real money is made by patiently holding on to great businesses. The market, in his eyes, is just a machine that rewards the people who can sit still and let their great companies do all the heavy lifting. Now, Buffett is never afraid to borrow wisdom from other great minds. Here, he's quoting the famous economist John Maynard Keynes to drive home a really key point. Stop diversifying just for the sake of it. Instead, you should make large, concentrated bets on the few exceptional businesses you truly, deeply understand and whose management you trust completely. All right, so we know we're supposed to focus on great businesses, but what actually makes a business great in Buffett's eyes? This next section breaks down how he separates the good from the truly exceptional, and he has a special word for them: franchises. This is the million-dollar question, or, in Buffett's case, the billion-dollar question. What is it that transforms a regular old company into an economic fortress, a true franchise? Well, the answer comes down to three very specific traits. And here they are. It's pretty straightforward, really. Number one, its product is something people either need or really, really want. Two, customers don't see any other good alternative. And three, the government can't step in and tell you how much you're allowed to charge. Think about companies like Coca-Cola or See's Candies back in '91. They ticked every single one of these boxes. And here's where the rubber really meets the road. A regular business is always competing on price, and a few bad decisions can kill it. Its earnings just sort of bob around. But a true franchise, it has pricing power. Its earning stream tends to grow and grow, and it's so strong it can even survive mediocre management. That's why $1 of earnings from a franchise is just plain worth more. Now for the perfect real-world example. Buffett often says that owning See's Candies taught him more about evaluating franchises than almost anything else. It's true. This small candy company ended up providing some of his biggest, most important lessons. So when Buffett and Munger bought See's way back in 1972, they had one critical insight. They realized the company could charge more for its chocolates without losing its fiercely loyal customers. See, people weren't just buying candy. They were buying a brand they loved and trusted, especially for gifts. That untapped pricing power, that was the hidden gem. And just look at these results. The company only needed about $18 million in additional capital over 20 years. But in that same time, it spun off an incredible $410 million in pre-tax profits that Berkshire could then go and use somewhere else. That right there is the definition of a great business, one that gushes cash without constantly demanding more investment.
Okay, this next part, this might be the most important part of the entire playbook. You see, greatness isn't just about what you do right. It's about how you handle what you do wrong. And Buffett is an absolute master at this. Now, listen closely to how he frames this. Buffett's biggest blunders weren't bad investments he made, they were great investments he failed to make. These are the sins of omission, the opportunities he understood perfectly but for whatever reason didn't act on. They're invisible on a balance sheet, but believe me, the cost is very, very real. And he gives a painful, specific example from that year, the Fannie Mae story. He knew it was a financial powerhouse. He started buying shares, but then the stock started to tick up a bit. He got impatient, stopped buying, and then sold what he already had. He actually called his own behavior amateurish and silly. And here's the price tag for that silly, amateurish mistake. Lesson 10 is just a number, $1.4 billion. That's the approximate gain Berkshire missed out on by selling Fannie Mae too soon. It's a brutal billion-dollar lesson in the incredible cost of impatience. So in the end, why did these lessons from 1991 still matter so much? Because they're not about stock tips. They form a timeless philosophy. It's about focusing on business value over market price, practicing extreme patience, understanding the power of a true economic franchise, and being ruthlessly honest about your mistakes, especially the ones nobody else can even see. And really, that's the final question this 30-year-old letter leaves us with. In a world of nonstop hype and trading, are you just building a portfolio, or are you building a company? Are you collecting tickers, or are you thoughtfully assembling a collection of outstanding businesses you want to own for the long run? Thinking like a business owner, that is the final enduring lesson from 1991.